Hey there, everybody, and welcome to Yahoo Finance Live. It is almost Friday. I'm Dave Briggs, along with my friend Rochelle Akufo. Nice to see you. Let's get you up to speed on the market action today. The gains accelerating on Wall Street. A lot of green on this board with tech stocks leading the way. This on the heels of another sign of cooling inflation. The producer price index falling 0.5% in the month of March from the prior month.
That's right, Dave. And we're also seeing a rally in crypto, both Bitcoin and Ethereum rising after a key upgrade to the Ethereum blockchain network. Ethereum in particular there, as you can see, up almost 6% on the day.
Plus, earnings season kicks off tomorrow with the big banks. What key phrases and themes you need to watch for to get a sense of the state of the economy and corporate America, as well as what it means for you and your money. But first, let's get you up to speed now on the latest from Amazon. Shares trading up more than 4% on the day. Their CEO, Andy Jassy, releasing his 2022 letter to shareholders where he reflects on the prior year and details what's ahead for the company. For more on this, we welcome in Yahoo Finance's Ali Garfinkel. Ali, always good to see you. What were your biggest takeaways from the Jassy letter?
So, Dave, if there's one big headline here, I'd say it's this. Amazon is officially entering the generative AI arms race. Now, we knew this day was probably coming, and Amazon in this letter even says we've been investing in large language models, LLMs, and generative AI for a while. And to that end, what's happening is Amazon is launching its own AI-based cloud service called Bedrock, which allows clients to build generative AI-powered apps with pre-trained models. It's important to say we actually, as we are talking about the risks of AI as a society, it's important to say that there's actually a lot we don't know about Bedrock right now, including the sort of data it's trained on. But all in all, big picture, this is a very Amazon-y take, isn't it? It's very B2B, and a lot of the clients that have been named are clients like Deloitte, for example, or Accenture, these very enterprise-focused companies. So, on that to that end, it's important to say that the generative AI market is going to be a huge opportunity. So from Amazon, I totally get it. I believe it's Grandview Research, which said the generative AI market can be worth close to $100 billion by 2030. And Amazon wants in. I keep asking, Dave, does everyone need their own ChatGPT? And the answer from Amazon's CEO, Andy Jassy, today was a resounding yes, at least for Amazon.
Yeah, we're going into an earnings.
AI.
Sorry about that. Rochelle, go ahead.
Well, I was going to say generative AI is really getting all the spotlight here. But what about the tried and true, the Amazon Web Services? What did we hear about that?
Yeah, I might get a little fiery here, Rochelle, because the Amazon Web Services story right now, frankly, despite those shares being up, isn't looking as optimistic as the AI story for Amazon. The reality is, I'm actually going to read you a quote from the letter. AWS faces short-term headwinds right now as companies are being more cautious in spending given the challenging current macroeconomic conditions. Now, reading between the lines here, this spells pretty bad news for AWS. Now, I want to take you back to Q4 2022. We saw this minor miss on AWS sales, if you recall, but that small miss had pretty big implications because at almost the same time, Microsoft was saying in its earnings call that we are going to see an imminent cloud slowdown. Now, I think, for instance, it's important to say that Jassy does offer some very encouraging takes on AWS in this. For instance, he offers a statistic that looks pretty darn good. Last year, AWS grew 29% year over year on a $62 billion revenue base. So that sounds pretty great. But Jassy says that he also believes that AWS is, quote, in the early stages of its evolution and has the opportunity for unusual growth. I'm just going to be real with you here. Every single cloud expert I talk to say those early days of high growth in AWS and in cloud in general are over. So I think there are still a lot of outstanding questions about where Amazon lands if AWS isn't a growth monster.
Indeed, at least for today, though, investors clearly seeing some upside here based on that letter as well. Ali Garfinkel, thank you for breaking that down for us. Well, Twitter has a new partner. Trading and investing platform eToro announced today that it's teaming up with Twitter. The partnership will allow users to see live charts when searching Twitter cash tags and have the option to click through and invest. Joining us now is Lule de Misset, eToro US CEO. Thank you so much for joining us today, Lule. So this is an interesting partnership. We got a bit of a hint when we saw that Twitter bird switch to the Doge dog there for a minute. But talk about this partnership and what it really does in terms of the growth for eToro, what eToro gets out of this.
Yeah, first of all, I think, it's our ethos that social investing is a bedrock of the future and has been so in these last 10 plus years. And so we're really excited to be in a place where partnership, where, the number of searches that happen using the cash, the cash symbol is humongous. And so we think the synergies between people doing financial searches, which is north of like 400 million so far just in this year on Twitter, and being a provider that is also a social investing platform, that synergy in the eyes of the consumer, we think is going to be a strong one. So the way it works really is that customer will search with the dollar sign in front of any particular symbol that they look at, and that will land them on the Twitter sort of page that shows them a little bit about the stock, and then more they can learn on eToro that is embedded into more research on those securities. So we think that it has twofold benefits for us. One is customers end up knowing more about us and the power of social investing. Remember, eToro is not just about where you do your trading, but also where you learn about investing. So that's one, where our user base now already is 30 million globally, and we think that that will help us grow even more. But the second is for people to then do the try investing side of the eToro equation, which is you can practice investing with using no money, or you can actually put money in an account and do it. So we think that that synergy creates more engagement and education around investing.
Nice to see you. FinTwit, as they call it, financial Twitter, really has had a dramatic rise of late. What is it about Twitter's model that allows for financial news to spread so effectively and so fast?
I think a fewfold. One is the simplicity and the ease of sort of like how short the messaging is, right? We live in an era where people can't read 5-page white papers about a particular stock, right? So just the mode of the sort of communication, I think, makes it much more so. And then the other is really the population that sits in Twitter, right? So a lot of Twitter's users are either consumers of news or consumer of financial news. So when you have a marriage of a platform that makes consumption easy and quick, with a marriage of the personas that are the right for it, it becomes a perfect synergy.
Now, for people who are wondering where eToro is available in the US, it's not available in New York, Nevada, Hawaii, and Minnesota, and also some US territories, including US Virgin Islands. But I mean, how could this move with Twitter perhaps affect regulatory approval and any moves to enter those markets?
Yeah, I don't think it's about regulatory approval because of this partnership, but I think we've demonstrated, I'm proud to actually say that eToro did win its New York license, which, as you know, is a gold standard of getting the ability to be in New York is really sort of, as they say, you can make it there, you make it anywhere. So we keep growing our state licensure, and New York was our latest win. And then in terms of how they get it, it's eToro.com. It's really simple, eToro.com. And when you do that, you enter the world of social investing news ecosystem, as well as being able to practice and invest in those 45 and more growing states.
If there was one textbook example of how financial news can spread on Twitter, it was unfortunately, most notably, the Silicon Valley Bank collapse, which was called by many the first Twitter-fueled bank run. What did you learn from that? And how do you protect investors?
Yeah, that's kind of why we actually started a social investing platform. We wanted to be able to have a social investing ecosystem that also had to be regulatory compliant, right? So when you come into our ecosystem and you're researching a particular security, you're going to have the what I call sort of like the unintended consequence or the moral hazards managed much better in our universe. So I think that what Twitter does is it gives us a larger town hall, if you will, to be able to engage and share ideas. But once you get into our doors, there's that sort of like belts and suspenders that we put on to make sure that the customer understands what they're doing.
And we know the SEC obviously still has a lot of scrutiny, which has affected some companies from going public, including eToro, as they really want to see more reviews here, a slower pace here. How is any of this perhaps changing the timeline for going public? I know eToro still plans to.
Yeah, I think for now we are focusing on our customers and our organic growth, which we're seeing globally. And one day that roadmap will lead to other options. But, as I said, we have 30 million users. 3 million, close to 3 million account holders. There's a lot of business that eToro does, whether it's public or not public, but obviously that's also something we'd like to have in our roadmap.
Twitter, of course, down from 8,000 employees to around 1,500. They've had 6 major outages this year alone. some erratic behavior from Elon Musk. You must have some concerns about dealing with Elon on the up and down fire hose of news that comes out of that platform, most notably the squabble between Twitter and NPR.
Yeah, to me, at the end of the day, I know it's a tempting thing in our society to just follow the red hot sort of noise that's coming out of it. At the end of the day, in my opinion, Twitter is a very solid platform in which really interesting dialogue and networking of communities happen. And that hasn't changed for us. With regards to the other elements of it, we see it as sort of the growing pains of, as I said, a global marketplace of different perspectives and voices battling it out, which is a good thing.
All right, Lule Demisay, really enjoyed the conversation. Thanks so much. All right, let's get a quick check of the market, sponsored by Tasty Trade. The markets are on fire today, and look at the Nasdaq up 2%, leading the way. The Dow also up, highest level in about more than a month. The S&P gaining 1.3%, all in presumption reacting to the positive number PPI early this morning. We are just getting started here on Yahoo Finance Live. Still coming up, turbulence for the airline industry. The sector has faced a fair share of issues over the past year, from worker shortages to massive technical disruptions. We'll hear from Delta Airlines CEO Ed Bastian on some of the biggest roadblocks the company is seeing for hiring more pilots. And Amazon is touting optimism for the future despite a difficult year for big tech. We'll break down what CEO Andy Jassy's shareholder letter means for Amazon's retail business. Don't go away. Delta Airlines missing on earnings and revenue in Q1, but the airline is forecasting a better second quarter as it relies on strong summer travel. Yahoo Finance's Brad Smith here to tell us what investors learned from the company's latest report. Hello, sir.
Hey, good to see you, Dave. Good to be with you here this afternoon as we've been tracking shares of DAL throughout the day. And it's been some interesting activity here as they try to reach a cruising altitude following this earnings report, where ultimately, you're taking a look at some of the actuals versus the estimates. It was a miss on the top and bottom line for this most recent, what they call the March quarter, but calendar year first quarter is what you think of that as. And ultimately, even as we're taking taking a look at some of those figures, let's also remember that this is still an airline that has not gotten back to its full pre-pandemic capacity, yet still is eclipsing some figures and even setting some new high marks as well. One particular high mark, they saw their 10 highest cash sales days in the company's history during the first quarter. So that one of the high notes. However, some of the low notes really kicked off when American Airlines kind of put out a sneakers app-esque shock drop, if you will, of their earnings report. We were just talking about sneakers app in the break. Well, anyway, here, as you think about what this kind of sets up for the rest of the airlines during the earnings season, it is with this broader context of where travel demand sits right now. And so travel demand, as I was running some figures based on TSA traveler passenger volumes, they averaged above the pre-pandemic levels for the entire quarter of the first quarter of 2023 here. That is the first time that we've eclipsed for an entire quarter a pre-pandemic marker, and that is significant because that is the exact demand that CEOs like that of Delta Airlines, Ed Bastian, really comment about when they talk about what is a multi-year resurgence that they're going to be seeing in travel here. And so that's something that they are expecting to continue as well, Dave.
That's a nice sneakers analogy there, my friend. You spoke to Ed Bastian earlier today about their plans to hire more pilots. What did he tell you?
So there was a lot to really dive into, especially when you think about the new contract that they were able to net with pilots and putting that in front of the union. And at the same time, the number of pilots that need to go into training as well. Here's a snippet of what he had to say.
We've hired over the last couple of years, between 3,000 and 4,000 pilots. So we largely are where we need to be. We continue to hire, I'd say now more at a normal attrition level compared to pre-pandemic levels. The challenge we have at the moment is we need to get all the new pilots trained, and we have a fixed number of training devices. We're doing well this summer coming up. We are minimizing the training. We've got most of our big training events already behind us, and we'll be able to put more and more pilots into the operation, which gives us the ability to fly a bigger schedule.
And so there you heard it from Delta CEO Ed Bastian, and even over the kind of quarters where we've been able to keep tabs on where those conversations are moving with pilots, where those negotiations have ultimately netted out is, of course, a higher cost for Delta, but still one that they would continue to talk about as competitive compared to the rest of the airlines as well. And in being able to take better care compensation-wise of their pilots and of the staff, that is something that they believe is a talent acquisition and retention strategy that's going to help out with Delta over that longer term as well, Dave.
Tell you what, I just flew cross country, 4 flights, all at capacity. I think the demand, it ain't going away anytime soon. We should always take a full shot of Brad Smith. You got to get the shoes in with Brad Smith. We need the full shot next time he's here. There you go. Nice effort. Brad, thanks, buddy. Appreciate that. Good job. Rochelle?
Nice kicks with that nice kick there. Now, tomorrow we're going to get first quarter earnings from some big banks that are coming out. Citigroup, JP Morgan Chase, and Wells Fargo all reporting. And we'll get earnings from one of the most prominent regional banks in the country, PNC Financial. Now, these reports will cue investors in on the impact from the banking crisis. Our next guest says banks generally set the tone for the health of the economy. So what kind of reading can we expect? Well, joining us now is Amy Kong, CI Barrett Private Wealth Chief Investment Officer. Good to have you, Amy. Now, it's interesting because this isn't your typical period for banks, given the fallout from SVB. So how might this be different? Is this still going to be setting the tone of what to expect for the year in this quarter, or should we wait till next quarter?
Hey guys, thanks for having me. Great to see you. I think this quarter will be important, but next quarter will be what investors will be focusing on. I mean, don't forget the fallout from Silicon as well as Signature happened in March, so well into the first quarter. So we really don't have a lot of time within the first quarter to see the fallout from some of these troubled banks. And so I think investors will be focused on a couple of things as we're unfolding bank earnings tomorrow. One is deposit trends. Clearly, the deposit trends will be quite different between larger versus medium-sized banks, and we're going to watch that pretty carefully. We should also expect that the tone should be probably more downbeat. Perhaps there will be a suspension of buybacks. I think capital ratios will also be elevated just in light of all the banks becoming a little bit more cautious, becoming a little bit more conservative going into the remainder of this year.
Yeah, when you look at the way per share earnings estimates have been written down, it's actually 24 where we're going to see, perhaps, according to the analysts, the biggest drop. We started Q1 with bank CEOs, I believe every one of them calling for a mild recession. What do you expect them to say about the tone of the economy, in particular Jamie Dimon?
Yeah, I mean, his annual report is a good tone setter, if you would. A lot of people pay attention to that. And the Fed minutes from yesterday also agreeing with his annual report. So I think the tone is likely to be downbeat. I think banks, as I've mentioned, will continue to play the conservative card. Not only because of all that's happened. I mean, if you think about the banks in general, they've got bonds that are sitting at a loss. They are probably thinking about, which is the next bank to experience a bank run. We hope not. And so I think the key is to keep liquidity as high as possible. And obviously, when you have that scenario play out, it will eat into profits. And so I would not expect, much more than a downbeat tone going into the next couple of days of earnings reports.
And obviously the Fed keeping an eye on that financial stability while also, of course, trying to get inflation under control. I want to talk about some of the moves that the Fed should be making. A lot of people saying perhaps they're being too aggressive, obviously still looking at some of that backward data there. Are they perhaps missing that the medicine has taken hold and that perhaps they should pause at the next meeting?
It's a great question. I think they ponder that on a daily basis. What I think has been supportive is the fact that CPI and PPI numbers have come down, but they are still well ahead of the Fed target. What I'm thinking, what Barrett's thinking as a group here is that the May meeting, which is only a couple of weeks away, we should still see another 25 basis point hike. From there on, you will get another couple of data points. And if we start to see CPI numbers or inflation data points continue to cool at the same measured pace as we've been seeing, then perhaps there could be a pause. But I think it would be premature to start pausing again in light of the data that we have seen. What we have also been observing is that the March numbers are 1% lower than the February numbers, but that's really a more mathematical thing where March of last year was a very high number and that got dropped off in terms of the calculations. And so I think the Fed really needs to see inflation stay lower and not shoot up again for whatever reason, supply, demand, et cetera, before they start thinking about a pause.
And the pause is one question. The cuts is another. Market's still pricing in a cut to rates later this year. What's your expectation?
We're in the camp that a cut is probably less likely for 2023. A pause is more probable depending on data, as I've mentioned. Now, if we do enter a recession in the back half of this year, which we should expect, or we could expect, the severity of that potential recession will determine if cuts are necessary. At this stage, it's still too soon to tell, but if we start to see again, the severity of a recession becoming a little bit more than what we're originally anticipating, then potentially cuts into the back half of this year, into first quarter of next year is likely, but we're not in that camp right now.
So as some investors get perhaps a little too ahead of themselves, waiting for that pause and that pause in rate hikes there, I want to ask you what you're seeing in terms of the intermediate action for stocks. What are your expectations for the next 6 to 12 months? What are you focused on?
Sure. We're watching the Fed obviously very carefully. I think, don't fight the Fed continues to be top of mind for many investors, and we believe in that quite very much so. Earnings, obviously, over the next couple of weeks into next month will be very important as well. Not only are the bank earnings very important, but we're going to be watching consumer-related stocks as well. One of the things that's been somewhat conflicting in all of this is the jobs market continues to be quite tight. And how we're really seeing or trying to see is whether or not the consumer and consumption continues to hold up. Right now, wage inflation is still positive, 4, maybe 4.5%. But if the cracks within the labor market starts to show more and more, that will obviously impact sentiment as well as consumer trends. And that's something we're going to keep in mind quite a bit over the next several quarters.
Certainly the strong consumer keeping the economy afloat at the moment. But as you mentioned, we'll keep an eye on some of those cracks that are still in the system. Amy Kong, thank you so much for joining us this afternoon. All right, coming up, Ethereum completed its highly anticipated Shanghai upgrade today. We'll tell you what this means for crypto investors on the other side of this break.
Let's get a quick check of the market sponsored by Tasty Trade. We continue to accelerate towards the close with gains across the board as the Nasdaq continues to lead the way in that capacity, up more than 2%, but a big gain for the Dow and the S&P. You know, it's the usual suspects here: Amazon, Alphabet, Meta, Tesla. They have driven the gains all year. It continues to be the story. That check sponsored by Tasty Trade. Rochelle?
All right, thanks, Dave. Well, Ethereum has completed its highly anticipated Shanghai upgrade, while crypto investors are reportedly encountering delays for withdrawing funds deposited on the Ethereum blockchain. The industry appears excited about the change. The price of Ether hitting the $2,000 mark today for the first time in 8 months. Joining us now is Scott Melker, host of the Wolf of All Streets podcast. Good to see you, Scott. So let's first start with what we're seeing. A lot of people wondering, is the crypto winter over, or is this just a brief reprieve? What's your take?
I was calling the crypto winter over about 9 months ago over the summer when we bottomed in June. Of course, we then had the Black Swan event of FTX in November, but quickly retraced that move to the upside. I think it's been crypto spring for quite a while, but people forget that spring is in like a lion and out like a lamb, and there are very horrible weather days in spring as well. So I think it's a little too early to start calling for a crypto summer, but I do think that we're transitioning and that the bottom has been in for quite a while.
And so a lot of people wondering, what are going to be the next catalyst? First of all, with Bitcoin, it's going to be halving next year. Break down what that means and what the expectations are.
In the most simple terms, every 4 years or so, there's a Bitcoin halving, which means that new supply coming onto the market is effectively cut in half. So even the most basic understanding of supply and demand, if new supply is being cut in half and demand even stays the same, reduces slightly or goes up, of course, that means that price goes with it. And we've had a 4-year cycle where we've basically seen price rising into the halving. Then a few months later, you have this this major move to the upside. And then we see these huge retracements of 75 to 85% coming into the next halving. Price starts to rise and we do it all again. If you had literally fallen on your head, been in a coma for the past couple of years, ignored everything happening in the macro, the entire bear market, you would look at a chart and see that we're still in the middle of yet another one of those same 4-year cycles.
And I want to talk Ethereum as well, the Shanghai upgrade, because obviously we're seeing, at least today, Ethereum off to the races here versus Bitcoin. I mean, up about almost 6% on the day. What are your takeaways from that? And obviously a lot of excitement surrounding this.
Yeah, there was a bit of a nonsensical narrative that everybody who had staked their Ethereum for the past few years was going to try to withdraw at once, which you couldn't do anyways, and sell all their Ethereum. But you have to remember that anyone who staked their 32 Ethereum, which by the way, for most people was over $60,000, but anyone who staked that 32 Ethereum had no guarantee they would even be able to withdraw. These are the people who are the biggest believers, the maximalists of Ethereum, who really wanted to help secure the network. So now that they're getting the opportunity to withdraw, they're going to continue staking. I think there were more people, and I can speak to this anecdotally from fund managers that I speak to in institutions, there were a lot more people who are actually waiting to deposit because they would then know that they would be able to withdraw at some point. So we're actually seeing net inflows over the past 24 hours. It's going back and forth, but there has not been a huge demand for people to withdraw, and there are just as many people putting their money into the contract. I think that this is a huge development for Ethereum, yet another major step in the right direction for the protocol.
And do you think perhaps investors are more bullish on Ethereum given the use cases versus Bitcoin?
I view them as completely separate assets. I think that the flipping narrative is completely irrelevant. I view Bitcoin as a digital gold store of value, flight to safety, and we've obviously seen that, especially with the banking collapses a few months ago and Bitcoin rising a few weeks ago, with Bitcoin rising from roughly $19,000 to over $30,000. Ethereum is more of a technological investment. It's the internet of value. And I think that we're starting to see that separation in people's minds. So I think you can love one, love both, and it's totally fine. You don't have to really choose. I think they're separate asset classes and should be viewed as such.
And so for people who are trying to, obviously, we're seeing more widespread adoption here, although with some scrutiny, as we mentioned there, from regulators, having people wondering, should I be using this as a security or an asset? But then now you have this partnership between eToro and Twitter, making it even more accessible. What's your take on that? Because when you throw in social media and obviously the speed at which misinformation can flow and misunderstandings as well, what's your take on that partnership and what that perhaps does to the adoption speed?
I think it's going to be great for adoption, both in the stock market and in crypto. eToro's founder, Yoni Assia, is an early Bitcoiner. He's a real firm crypto believer, and I think that that's going to be huge for this market moving forward. But really, I think that this is more bullish for eToro than anyone else, because if you click on a cash tag on Twitter, you see that market data and you want to trade. I think it's obvious that you're still going to have to become an eToro customer or go through KYC to be able to do that. I do think that we live now in a hyper informational market where things travel at the speed of light. I mean, even with the bank runs we saw in Silicon Valley and Silvergate, you're talking about 42 billion in withdrawals in a day. That was something that would have taken weeks or months in the past. So with that fast information and the fast moving market, I do think that this is going to increase volume and excitement around both crypto and the stock market moving forward, especially with that younger retail audience.
And so I hate to put you on the hot seat here, but in terms of where you see Bitcoin and Ethereum's prices going, what's your outlook telling you?
It really always depends on timeline, and nothing makes you look like more than a fool than pretending you have a crystal ball and then attaching it to a timeline. But I think that in general, we will see probably a choppy market for quite a while. I think it'll be the same for stocks, maybe some retracement coming soon for Bitcoin and Ethereum, and then slightly higher prices going into the end of the year. And then once again, since you brought up the halving before, I think next year, May 2024, April 2024 is when we're expecting to see that. I think a few months after that is when we'll see the next true bull market.
We'll definitely be keeping an eye on that. Always great to have you on with your insights. Scott Melker there for us. Thank you for joining us this afternoon.
Yeah.
All right, coming up, CRISPR Therapeutics jumping after Cantor Fitzgerald launched its coverage with an overweight rating. We'll tell you why the analyst behind the call likes the stock next.
All right, time now for Triple Play. 3 stocks we're watching in the final 30 minutes of trading. AB InBev, Chegg, and CRISPR Therapeutics. Bud is my play. Anheuser-Busch, InBev, or Bud as you know it. Bud Light this time, embroiled in a brouhaha, you might say, since it started this promotional campaign earlier this month with transgender TikTok influencer Dylan Mulvaney. Now, the TikToker posted a video drinking a custom can of Bud Light with her picture on it, which led to an all-out revolt on the right. Boycott Bud Light has been trending on various social media platforms. Kid Rock used Bud Light cans for target practice. Bars in the Midwest reported steep drops in sales, and at one point, Bud shares had lost more than $5 billion in market cap since this began April 1st. However, Citi analyst Simon Hale says it's all overdone and could represent a buying opportunity. Quote, "We view the weakness as providing another attractive entry point for investors," adding, "Although brand volumes in some states may see short-term headwinds, we do not believe these will be material nor long-lasting." Evercore analyst Robert Ottenstein told the New York Post it's way too early to know how this controversy will hurt the Brewers' bottom line. Now, Bud shares are up today, not dramatically, a little more than 1.5% at the moment, but still down around 4% since this all began April 1st with that TikTok video. And Josh, this isn't going away anytime soon. The analyst's point is a good one, that in the long run it may represent a buying opportunity, but I'm surprised the chief marketing officer didn't initially suspect that there'd be some backlash. A bit off-brand when you consider the demographic for Budweiser and Bud Light.
Yeah, I think part of it, though, is they're confident in who their consumer base is, right, as far as a long-term run, right? I think Bud Light drinkers are pretty loyal to drinking Bud Light, at least from all the white beer drinkers that you and I both know, right? People kind of have a pick there, and they sort of stick with it. Yeah. So I can understand backlash. Maybe you were just talking about some of the social media backlash you see, but how much does that actually impact sales and impact sales in the long run? And then as Citi pointed out in that note, maybe there's a Gen Z play here to start doing something different with your marketing and bring in a younger demographic. Obviously, Gen Z, my generation, isn't as big of beer drinkers right now. So maybe start appealing to that, I think, is probably a good play.
Let's bring in Rochelle on this, because Rochelle, I'm curious what you make of it. Like, Gen Z, are you going to really bring them into the fold when it comes to Bud Light? I suspect no, but you may know better.
I mean, I know that, InBev was saying they wanted to sort of change the image of your typical Bud Light drinker, perhaps bring more people into the fold. Perhaps not the most thought through concept, but I mean, I get it. They're trying to engage, and where are people? Where's Gen Z? A lot of them are on TikTok. So you meet people where they are. Perhaps in the long run, this could pay off. It could bring in more, Bud Light fans. Still remains to be seen. As you mentioned, they're taking a bit of a hit at the moment, but I mean, rebounding as well. So we'll have to see how that plays out.
All right, we'll stick with Gen Z, and another thing Gen Z likes is ChatGPT, right? So my play today is Chegg. Shares rising ahead of a highly anticipated meeting between Chegg CEO Dan Rosenzweig and OpenAI CEO Sam Altman on April 17th. Now, Jefferies analyst Brent Thill pointing out in a note to clients today that this meeting will be critical to the future of Chegg, given the lag that ChatGPT has had on Chegg shares over the last few months. Shares of Chegg entering today down roughly 44% since that ChatGPT beta launched on November 30th of last year. Thill noting that a partnership with OpenAI could be announced at that event next week. Thill also adding that the ChatGPT integration could provide students with live conversational interactions and also produce additional study materials. And Rochelle, I guess sticking with the Gen Z theme here, are you comfortable with that, with ChatGPT being involved in kids learning? And obviously Chegg is something kids used to study now. I'm curious just your overall take on ChatGPT now being involved in that process.
I mean, you have to wonder if all of a sudden, like, the entire grade is going to end up having the same answers and potentially having them be wrong, because, there's still some kinks to be worked out here. But I mean, it's good to see that they're finally catching up and really stepping up to the plate in terms of AI, because that was one of the criticisms, that they were perhaps getting left behind by not being as proactive as they could have. And then another criticism is, look, there hasn't been as much focus on customers as there has been with shareholders. They've been focusing on buybacks. So perhaps this is their way of catching up, certainly brewing a lot of excitement here. I'm not opposed to it being something that assists, that ChatGPT assists, but you don't want kids sort of just relying on this. Have to check your sources, as we all do.
Yeah, I just assume $113 stock in February 21, kind of the Peloton-like stay-at-home play.
Sure.
In their earnings call, 22 mentions of AI. 22 mentions. I think they had no choice but to hop on to survive.
Had to catch up at some point.
Yeah.
No, it was either that or their lunch was going to get eaten, plain and simple. I'm shifting gears now to my pick, which is Swiss biotech firm CRISPR Therapeutics. Now, the stock jumping, as you can see, they're more than 16%. That's after Cantor Fitzgerald launched its coverage with an overweight rating and a $72 per share price target. As you can see there, from right now, it's at $50. Now, Cantor is expecting the potential FDA approval for CRISPR and Vertex Pharmaceuticals' gene editing therapy, IXIC, alongside Bluebird Bio's Lovo-cel. On CRISPR Therapeutics, analyst Olivia Breyer notes the company has a very good chance of commercializing the first ever CRISPR gene therapy later this year. This is a game changer when you think of what this means for sickle cell disease and beta thalassemia. Now, this actually comes on the heels of drug pricing watchdog ICE's report suggesting a price tag of between $1.2 and $1.7 million annually per shot, but would still be cost effective up to a price tag of $2 million. Now, to have some context here, these sorts of therapies do have more leeway with the pricing. They really do factor in things like the savings over the lifetime if these do prove to be safe and durable. ICE notes that the proportion of patients achieving treatment success was estimated at about 97% when they used both therapies. And of course, ICE's chief medical officer saying this may mean the day has nearly arrived to, quote, address the underlying genetics of sickle cell to achieve a cure. So a lot of hopes coming on the heels of this, and a lot of excitement, and clearly investors on board as well.
Yeah, there's some eye-popping price tag. All right, Josh Schaefer, thank you for playing, my friend. Coming up tomorrow, big banks kick off earnings season. Analysts expecting a volatile quarter. We'll break down which companies you should be watching next.
Earnings season officially kicks off this Friday with the big banks, and analysts have pretty low expectations. Joining us now is Scott Krisaloff, the transcript editor and Avondale Asset Management founder, and he keeps a close eye on earnings calls. Scott, now you said First Republic Bank is the earnings call that you're anticipating the most. Why is that?
Yeah, I mean, I think it was at the center of the storm around the whole banking industry a few weeks ago that seems a far way away now, but at least at the end of the quarter was still under attack. And so really looking to see how deposits were affected at First Republic. We know that there were outflows, but how great were those outflows, and what does the resulting balance sheet look like relative to its capital? I think it's really important to watch that. If there's a negative surprise there, it could reignite some of those banking concerns that we dealt with a few weeks back.
And one of the themes you told us you'll be watching for is the state of the consumer. You pulled a quote from Tuesday's CarMax earnings. Let's take a listen.
We see the traffic top of funnel, so it's not top of funnel. The degradation really happens at the conversion point, and which can make sense. As you find a car that you like, you start working through it, and all of a sudden you realize, wow, that monthly payment is more than I can afford, and then you see where they fall out, which is the reason why we've been talking about vehicle affordability as one of the biggest factors that impact our sales. So it's all about conversion, not necessarily top of funnel.
So what does that signal to you about what's coming this earnings season?
Yeah, I mean, I think the consumer is the biggest thing to watch right now. Obviously, we've seen a very strong consumer for the last several years. There was so much stimulus that was put into the economy through COVID that hit the consumer. And consumers have a bunch of excess savings, excess deposits that they've been working through and consuming with. And some of those are starting to dwindle. JP Morgan said last quarter that by the middle of this year, they expect some of that excess savings to go away. And so how is that impacting the consumer? CarMax was a really good indicator of, on a big ticket purchase, people still feeling like they want to make that purchase, go into the showrooms and see the cars. But really, when you do the math on it and look at higher interest rates, et cetera, maybe that car purchase isn't something that we actually want to do right now, or it's not really the right time. That's a sign of some deterioration in the consumer that we'll be looking for other commentary around things like that this quarter.
And Scott, we know that Jamie Dimon also mentioned the strength of the consumer being at least one of the things that might offset some of the headwinds as we see some of these rumblings of a recession. But what about some of the other repercussions, some of the companies where you do see that spilling over from the labor market as well as real estate?
Yeah, in terms of the strength of the consumer, obviously consumer spending has been a driver of inflation for the last couple of years, this inflationary period that the Fed is trying to fight with higher interest rates. And so if the consumer is starting to weaken, the big implication is really on interest rates and Fed policy. And maybe the Fed can let up on some of the tightening that they've been pursuing for the last year and a half or so. And that obviously would have huge implications for security markets and the ability to get out of this bear cycle that we've been in.
Scott, how do you expect work from home, remote work versus return to office to play out this earnings season?
Yeah, this is a really interesting question. I think this is one of the last vestiges of COVID that we've still been working with, that the rest of the economy has kind of returned to normal. And, 2 years later, it feels like COVID is just an afterthought at this point. It's hard to remember how all of us were, working from home for a full year. But as we're getting farther away from it, I think a lot of companies are talking about being more productive in the office, expecting people to come back into the office more frequently, 3 days a week, 4 days a week, maybe even 5 days a week. We'll see here. And in this quarter, we may get some more commentary around some of those trends.
And obviously, ever since OpenAI, all we talk about is generative AI and a lot of these companies trying to jump at the forefront. But as we look at some of the nuances and how these companies are using AI, what are some of the ones that you're going to be looking at this earnings season?
Yeah, I mean, I think that the AI adoption is definitely going to be broad within the economy over time. And there's some companies that are at the forefront of that. I was listening to you all talk about Chegg in the last segment. And so companies like that are on the front end of AI adoption are ones that you'll really watch closely in terms of the way that they're adopting AI into their own companies. But we saw this, in bank quarters. I'm sure we'll see it. I think we'll probably see it throughout the economy. Fortune 500 companies generally will probably be talking in some way about how they're adopting large language models, but it will affect some more quickly than others.
All right, Scott Kristoff, check back with us after this earnings season. Appreciate you being here. Now, with bank earnings underway, weakness in the commercial real estate market will be top of mind. Offices sit vacant. Hybrid work remains popular. It's the biggest problem for the largest cities in America. What cities are specifically struggling the most? Let's find out from Yahoo Finance's Danny Romero. Danny, nice to see you. So who is struggling to get people back to the office?
Dave, Houston and Dallas are have an office vacancy problem. Both cities overbuilt over the last decade when interest rates were low. And remember, Houston and Dallas never shut down during the pandemic. So in theory, they shouldn't have empty office buildings, but that's not the case. Dallas and Houston have long lived with empty office buildings due to booms and busts, including the oil bust that happened in 2014. Houston never recovered. But one advantage that Houston and Dallas have is that they're able to bring workers back into the office, unlike cities like San Francisco and Washington, D.C. But some experts say that that really won't drive up demand in the office space, as businesses really reevaluate their head count. So an area of concern will still be supply. Dallas and Houston didn't stop building during the pandemic. There's a ton of construction underway. And another area of concern for landlords is refinancing. In Houston, landlords are sitting on about $1 billion of commercial real estate loans that are set to due later on this year. Dallas is sitting on $334 million of maturing loans. And landlords are getting antsy. They're offering discounts between 25 and 65% in the sublease market, but that's not really moving the needle, Dave.
Yeah, it is a tenuous time for anyone in the commercial space, specifically office. Danny Romero, good stuff. Thank you. Companies have tried all sorts of things to get workers back into the office: free food, entertainment, even threatening termination. But now some are taking to docking compensation. Wall Street law firm Davis, Polk & Wardwell, LLP, has told employees this week that those who don't adhere to their 3-day-a-week attendance policy would see a reduction in their bonuses. Also this week, JP Morgan sent out a memo telling employees that they will now be required to be in the office 5 days a week. And earlier this year, Disney and software companies Qualtrics have asked employees to be in person 4 days out of the week. Rochelle, what are your thoughts specifically about that law firm who is tying in office directly to your bonuses? So now this is a metric to evaluate your performance in a sense.
So I think the law firm one is an interesting one, because if it's all about billable hours, wouldn't you rather have people spending less time commuting and instead, making up those billable hours? So I thought that was an interesting one. JP Morgan, look, Jamie Dimon has made no bones. He wants people in office. That's where the relationships are built. That's where some of these, you're able to react quite quickly. There is that layer that's needed, that comes from working from home that you don't have. Maybe you can't react as quickly when there's breaking news, especially when you have things like banking collapses. The law firm one, though, I'm not sold on that. I think someone just had to come in 5 days a week and they felt a bit bitter and they're taking it out on the people at home. Because I'm like, you're billing the hours. What difference does it make where you're doing it?
I hadn't thought of it from that perspective, so well done on that. But, on the other side, this is only Tuesday, Wednesday, Thursday that law firm is asking employees to come into the office, which seems like, well, for some of us, seems like an ideal schedule, getting to be home on Monday and Friday every week. I think this sounds fair, and I think, in fact, it's just saying, look, we're going to pay you to be here. That's how we think we're going to grow as a law firm. I just don't see these numbers really growing. I've been really watching that Castle Systems badge swipe number, and it really hasn't budged at all. It might tick up 1% here or there, but it's really plateaued, flatlined, in fact, right about 48, 49% in terms of the 10-city average. I just don't know what's going to change that dynamic. I think people have changed their priorities. They just don't want to be back in the office, and if they don't get it from their employer, they're going to go out and find somebody who will give them that. I can't imagine that number will ever be above 52, 53% ever again. What do you think?
I mean, when you think of where the unemployment rate is at the moment and how hard it is for some of these companies to hold on to workers, I think some of these workers might be waiting for these companies to call their bluff. Like, are you really going to fire me? You've invested all this time and this energy. I'm doing the work. I'm not doing it in the location that you want me to. Because you have to remember, during COVID, some people moved to entirely different cities. Maybe they don't want to be back in New York if they've, moved to the sunny shores of Florida. So I'm not sure what it's going to take. It might take the unemployment rate ticking up a lot higher in order to really incentivize people to to just sort of buck up and come back into the office. But if the free food isn't doing it, I mean, that would have been enough for me. I don't know what else will.
Well, for those a little inside baseball, whenever there's free food here in Yahoo, now you're in DC, we missed you. Whenever there's free food here, man, the attendance spikes. It probably doubles every Thursday. This is when we get lunch. So that's a pretty effective incentive around here. But to your point, I think if the Fed gets their way, which shows what I think an unemployment rate around 4.6%, then the tides will turn and then those workers may come back to the office. But if the Fed doesn't get their way in terms of unemployment, yeah, we're going to continue to plateau below 50%.
Yep, they've got options. I will have to leave it there, but coming up, we're counting down to the closing bell on Wall Street. Stick with us on Yahoo Finance Live.
All right, we're just minutes away from the closing bell and a lot of green on the board. Let's bring in Yahoo Finance's Inez Ferre to break down today's positive market action.
Dave, we are going to end the session near the highs of the session with the Dow up more than 1%, the Nasdaq and the S&P also higher. Taking a look at the sectors that have been leading throughout the day: consumer discretionary, communication services, technology. Over on the Nasdaq 100, you can see the mega caps really gaining. Amazon up more than 4.5%, Apple up more than 3%. Microsoft is going to end higher, so will Alphabet and Meta as well. We are watching Bitcoin. Bitcoin continues to hover above 30,000 per coin, per token, up more than 1.5% over the last 24 hours. And then just want to show you what's happening with commodities, because we are seeing today oil down, silver, gold up. Here's the closing bell.
Well, let's do a quick check of the market, sponsored by Tasty Trade, to see how things ended this Thursday. Off the session highs, but still in very solid territory there for the Dow, that you see up more than 380 points, up 1% on the day. The S&P also rallying there, more than 54 points on the day, or 1.3%. And the tech-heavy Nasdaq, strongest gainer of the day, just shy of that 2% mark, but gaining 236 points. As we sort of circle the drain, waiting more of this information as we wait for the Fed's next big decision.
All right, let's take a look at Amazon shares. One of the movers today, closing higher as CEO Andy Jassy releases his annual letter to shareholders. You can see up more than 4.5% on the day. Investors apparently overlooking Jassy's comments on a short-term headwinds for AWS. A lot of takeaways from this shareholder letter. We're going to dive into the retail aspect of it later on in the program. What jumped out to you, Rochelle?
I mean, I was surprised that the shares weren't more affected, but they seem to be buying into this longer game that Andy Jassy was referencing there. And also, they obviously still on board with what Andy Jassy is doing. A lot of companies talking about this being the year of efficiency. So perhaps happy to see some pullback in some areas and really more responsible spending here for Amazon. Because, you know, at one point, Amazon was spending quite lavishly on things like some of its, you know, Amazon Prime and also some of its streaming aspects as well. So a little bit of a pullback there, but at least tempering some of the expectations. So as you can see, they're still in very positive territory so far. Also looking at shares of LVMH hitting a record high today as the luxury retailer reported better than expected first quarter sales. Revenue for the first quarter increased 17% from the same period a year ago, handily beating estimates as demand for luxury goods remains strong. Now, it's interesting because this luxury consumer didn't take their foot off the gas throughout the pandemic. A lot of people wondering, you know, at what point, even with inflation, are we going to start to see some cracks? Luxury spenders continuing to spend here and buoying some of the retail that we're seeing here, Dave.
It's remarkable, Rochelle. Incredibly resilient end in terms of the high-end consumers. Just look at Lamborghini continuing to shatter records and Bentley and the like. We just see an awful lot of that. That's the good. The bad for LVMH is day 12 of protests in Paris, protesting against the move to raise the retirement age from 62 to 64. And those protests were focused on LVMH headquarters. In fact, that's what you're looking at right there. Rather violent, ugly scene there for LVMH as they continue their anger at that subtle move. Tomorrow, big court ruling to determine the constitutionality of increasing that retirement age. And finally, taking a look at JP Morgan. Shares of the bank closing up slightly as earnings from the lender are expected tomorrow before the market open. This will be our first look at the banking sector since the collapse of Silicon Valley and Signature Bank in mid-March. It's not just the earnings, but it's always, my friend, the commentary from JP Morgan, what he says about the macro, the consumer, and the likelihood of a recession.
And obviously, when we spoke to our guest earlier, we said that we might not see at least the full effects of what we saw from the fallout from the banking crisis show up until the next earnings quarter. But JP Morgan, you know, considered something of a bellwether here. But when you think about the fact that it was these regional banks that had overexposure to some of these interest rate sensitive depositors, it's hard to really get a good picture of whether JP Morgan will reflect sort of the broader impacts for the industry. But in terms of the macro, we know he's been talking about, you know, some of these storm clouds for a mild recession continuing to build. As he says, those repercussions from the banking fallout still going to be felt for a while. Well, let's also take a look at generative AI models. We know they've exploded in popularity in recent months, and professionals across the working world have been incorporating bots like ChatGPT and Bard into their workflows. But what about Wall Street? Can AIs make stock picks or market predictions? To discuss, we're joined by Data Trek Research co-founder Jessica Rabe. Jessica, thank you for joining me. So a lot of people want to sort of go straight into the races when it comes to generative AI, but you have to kind of take it with a grain of salt in terms of how you expect it to be used when it comes to Wall Street and banking and financial advice. What are your big takeaways there?
Yeah, absolutely. We look at disruptive technologies every day at Data Trek, and certainly generative AI was one of the most interesting technologies we've seen over the last decade. So we went to both OpenAI's ChatGPT and Alphabet's Bard, and we asked both AI models a slew of investment questions to see how they'd respond. And our overall takeaway is that they have a long way to go in terms of being accurate, useful, and reliable investment tools for investors.
All right, so earlier today, I want to mention our colleague Inez Ferre spoke with the University of Florida Business School professor Alejandro Lopez about this. Listen to what he had to say.
It will definitely increase the productivity of analysts in the first place, right? If you have a big technology that's able to help you calculate thousands of headlines and just tell you what the expected result is going to be, it's probably going to make the job so much easier. So I would definitely be expecting a lot of investment professionals to incorporate this kind of artificial intelligence tools. Markets will become more efficient. As soon as everyone is using ChatGPT to predict returns, then there will be no more predictability because the market will incorporate the information fairly quickly.
Jessica, your thoughts on the professor's characterization?
Sure, I'm sure over time as these models improve, okay. But just to give you one example, we asked both ChatGPT and Bard a very simple question right off the bat. How did U.S. stocks perform last year? ChatGPT could not be further off. It said that U.S. stocks, or the S&P 500 in particular, rallied 27% last year and was actually up for the 5th year in a row. Well, obviously, stocks had a very poor 2022. And even if stocks were up last year, it would have only been the 4th straight positive year in a row, not the 5th, because U.S. equities were actually down on a total return basis in 2018. Now, Bard was more accurate. Bard said that the S&P 500 had a bad year. It was down 19.4% last year. And that was correct. However, it didn't decipher that was on a price return basis, not a total return basis, but even still more accurate than ChatGPT. So that just goes to show that, yes, it's an interesting technology if investors want to use it in their investment process. And see how the technology develops over time. We certainly understand that. However, you really have to do your homework, and you really have to fact check their answers because their accuracy can be spotty.
And you also did ask about predictions for best performing and worst performing stocks and how the market was going to fare as well. We did see that ChatGPT didn't really seem to be willing to give an answer there, a little bit coy, if AI can be coy, whereas Bard, at least was making some projections. What is the difference then in terms of investors? Is it better to not rely on Bard's advice versus ChatGPT saying, look, this isn't our area of expertise past a certain date?
Yeah, you raise a great point. They give very different answers, whether it be, so ChatGPT refuses to give recommendations, whether that's on an individual name basis or on a sector basis. It says it cannot predict the future, and it really errs on the side of compliance, just encouraging investors to perform careful research and analysis. Bard, however, is very willing to give recommendations. So, for example, when we asked, what stocks do you think will outperform in Q2? Bard gave 5 names as well as a couple of sentences as to why. They were all big tech. We would point out, though, however, that Alphabet was on the list. Now, of course, Alphabet owns Bard, so we don't think SEC regulators would look too fondly on Bard recommending the stock of its parent company, especially having not disclosed the relationship. Another thing we asked was, which stocks you think will underperform in Q2? And Bard also gave 5 names for that. However, another thing we found curious was it included Cruise on the list and gave the symbol CCL and referred to it as an electric vehicle company. Now, Cruise is, of course, electric vehicle unit of GM, but CCL, the symbol, is actually Carnival, the cruise line. So very, very different companies.
Yeah, indeed. So are they covering their legal bases? Is there fine print that just suggests no one take financial advice from either one?
I think they're both figuring it out. Certainly, ChatGPT gives very generic responses, ones that are more out of an economic textbook and won't get them in hot water with regulators. So, for example, it doesn't give stock or sector recommendations. Bard, however, we certainly saw that not all of its responses were in the spirit of current U.S. securities regulations, and recommending Alphabet stock is just one example of that.
Of course, like everything else, it's moving at light speed, and what we're saying right now may be irrelevant in a couple of months, right, Jessica? Good to see you. Thanks so much. Very interesting topic. Coming up, Dan Snyder reportedly nearing a deal to sell the Washington Commanders. Find out where things stand this afternoon and see how a pivotal role sports will play in the next phase of the streaming wars. Stick around. Washington Commanders owner Dan Snyder is on track to sell the team for $6 billion, according to the New York Times. The group who's said to be buying the team is led by Josh Harris, who owns the NBA's Philadelphia 76ers and the NHL's New Jersey Devils. Yahoo Finance's Josh Schaefer here to tell us about this record-setting NFL deal. Makes the Broncos look like a bargain at this point, man.
It definitely does, David. So this is a developing story right now today. So Sportico first reporting this earlier this afternoon. Now the New York Times also reporting that Josh Harris has agreed in principle with his group to purchase the Washington Commanders for $6 billion. Now I should note ESPN's Adam Schefter tweeting out just moments ago that this is not a done deal. He has the deal at $6.05 billion and says that Steve Apostolopoulos is still involved in the process as well. So there is still a little bit up in the air here, but it does seem like Harris, who already owns the Sixers, who already owns the Devils, the co-founder of Apollo Global Management, the parent company of Yahoo, is going to be the buyer. And I think one of the bigger takeaways here, Rochelle, is the buyer isn't Jeff Bezos. Not that there was necessarily always an understanding that Bezos would be the buyer of the Commanders, but plenty of speculation for Amazon becoming further tied to the NFL here and Bezos buying his hometown team. That doesn't look like it's going to happen. And I think that's one of the bigger takeaways for me is not seeing, that Amazon NFL tie get tighter.
I mean, we did see a lot of DC fans wondering, if we would see Bezos perhaps in the stands at some point. A lot of excitement here. Looking at the price tag, I mean, I've seen this sort of a tendency. Some of it is, your diehard fans. Some of it is for a flex. This is how DC is. What's your take on the price tag and what this perhaps means for the next deals when you do have a bar that high at this point?
Yeah, and everyone we've talked to over the last couple of months when we talked about sales as a whole have said these sports valuations are not a bubble, right? That you're going to keep getting revenue and keep gaining money back, and really it's worth it. I mean, you look at Snyder bought this franchise in the 90s for about $750 million. He's now selling it for $6 billion. Again, that's $1.5 billion more, Dave, than what the Broncos were sold for last year. I think that might be the most eye-popping part of this is, were the Broncos cheap? People said at the time the Broncos could have been cheap. That was an opinion that was out there. This might be proving that in some ways.
Well, the early buzz is that the Waltons overpaid that number for the Broncos, but it quickly turned to, oh my goodness, they actually got a deal. And yeah, it does look that way. And it's interesting with Dan Snyder, circled by scandal for the last, really 10 years, gets 8x his money, to your point, since 1999. What an incredible turn for him. And you just can't wonder, when we'll hit that $10 billion NFL market. It must be a matter of when, not if.
Jerry Jones told us last fall he wouldn't sell the Cowboys for $10 billion. So it won't be the Cowboys, but hopefully it is someone.
Now, not approved until the NFL meetings the 22nd of May, I believe. Josh Harris is a slam dunk. I can't necessarily say that about Apostolopoulos if he gets in. Josh Harris, unanimous approval from what I understand.
Absolutely.
Good to see you, my friend. Thanks so much. That's Josh Schaefer. All right, the NBA playoffs are set to tip off this weekend after a regular season that broke some records. The league announcing this week it set new records for total and average attendance at games this season while selling out a record 791 games. The NBA hoping to carry that momentum into strong viewership numbers on ESPN and TNT this spring. Joining us now for what the NBA's success could mean for Warner Brothers Discovery and the overall outlook for the company amid the launch of new streaming platform Max is Brett Feldman, Goldman Sachs Managing Director. Good to see you, my friend. So curious with this new deal coming up, and obviously Warner Brothers Discovery looks like a front runner with Disney, but how does the entrance of Amazon and Apple into the sports streaming world raise the price or at least complicate the matter for two companies that are in relative cutback mode?
Well, thanks for having me here. It's great to be on the show. It's really a question about competition. You had the word up there, streaming wars. Investors have been talking about streaming being a war for a long time. And really what the war is about is engagement. You're trying to get your consumers to sign up for your service and to stay with your service. Because when you have a cable or a satellite package, you pay for it as if it's a utility, even if you're not technically in a contract, but you can toggle in and out of your streaming product anytime you want. And I really think that yesterday's event, the Warner Brothers press event to announce the new Max product, was really them trying to show the market that they think they're building a streaming product that's going to create that level of engagement so that they can get the profitability over time.
And so in terms of timelines then, when you look at what we're seeing with NBA attendance, how soon will that start translating I guess more so when we see the bottom lines for some of these streaming companies?
The question is obviously cost. If you look at what's gone on with sports rights, the NFL contract that was signed not that long ago is the most recent example of it. These sports rights have been doubling or tripling in value as they go through a renewal cycle. That's exactly why the value of these teams have been going up so much, which you were talking about during the prior segment. Meanwhile, viewers are moving out of the pay TV ecosystem where they've been so much locked into their subscriptions and into an environment where they can toggle in and out, as we just talked about. So really what companies like Warner or any other traditional media company that has been a partner of the leagues has to do is figure out how to contain that cost. Because the overall value of the rights are going to keep going up. So they have to ask themselves, does it make sense to pay the full freight to maintain the package of games that I've had all along? Or is there some way I can work with the leagues and maybe additional partners to get a contract where it's a manageable cost for me, it brings just enough entertainment, sports entertainment to my viewers, and I can grow and I can make some money?
Now, it was interesting, David Zaslav talking in this presentation about the sports assets they have, which are impressive. March Madness, we mentioned the NBA, the NHL as well, but they will not be folded into Max, and neither will news, CNN. Why not? And at some point, do you think those are all under that streaming umbrella?
Well, really, we don't know. They kind of teased a little bit at the press event, saying that they do expect that they are going to have live news and sports as part of their streaming offering. But to your point, they didn't explicitly say that it was going to be part of Max. They also said, we're going to come back and let you know what we're doing in a couple of months. I think what most investors assumed is that that means they think in a couple of months they will have resolved their negotiations with the NBA, thereby knowing exactly what they can fold into their streaming service and whether they're going to bring a separate service to market that is based on live news and sports, or maybe whether it's some enhancement to the Max product. We just don't know yet.
And obviously, a lot of companies have been pulling back on their ad spend. What sort of opportunity does this open up?
Well, it's both sides of the coin if you're looking at a Warner Brothers Discovery. So in the case of Warner Brothers Discovery and many other traditional media companies like Paramount and Disney, what that means is that their traditional networks businesses are seeing a degree of pressure on advertising. That's not just because of the economy, but it's also because you are seeing more advertising inventory being made available to them on streaming platforms. In some cases, it's from the exact same companies, meaning Warner is offering advertisements on HBO, or Max as they're now calling it. Disney is now offering advertising slots on Disney+. And so I think the hope is that if some of the advertising spend that the advertisers are hoping to take away from those traditional channels moves into the streaming platforms, it's going to move on to their platforms. The problem is they're not the only ones out there with advertising. Netflix is out there with advertising. Obviously, there's some mainstays like YouTube and very popular platforms like Roku. So it may not necessarily be that advertising in aggregate is going down. The question is, where is it going?
All right, also a question about where Disney is going. You are bullish on the company. Stock's up 13% this year. We've heard a lot about Bob Iger's plans to reorganize the company, about some cuts and about siloing off ESPN. But in terms of the catalyst for growth, what is it as you see Disney right now?
They got to figure out how to make money in streaming, and they'll tell you that that is absolutely the number one priority for Bob Iger and his management team as he goes through what is supposed to be a 2-year stint in the CEO role. They had record losses in their streaming segment in their fiscal fourth quarter, which was 2 quarters ago. They lost $1.5 billion on streaming in that quarter alone. They were able to show some progress towards mitigating those losses as they moved into the early part of this fiscal year. And their anticipation is that they're going to break even or make some money at some point next year. But they still have to show investors how they're going to do that. And inevitably, what that means is that they're going to have to pay close attention to costs. They're also going to have to make sure that they are pricing their product effectively. One of the home runs that we've seen out of Disney very recently was a price increase on Disney Plus that they flowed through the service late last year. It was nearly a 40% price increase. It's sort of unprecedented, the extent to which they took up price, and yet according to the disclosures by management, it had almost no effect on their subscriber trends, meaning that what they've learned is that consumers continue to value their content just as much in a streaming world as they have in the old world of movies and television.
Certainly seeing that spread throughout their ecosystem. Very interesting insight there. Brett Feldman, thank you so much for joining us this afternoon.
Great to be here.
All right, coming up, Andy Jassy telling shareholders that he wants to grow Amazon's grocery business. Is that a good move, though? We'll get an analyst take next.
Inflation is coming down and unemployment remains low. The American economy appears to be improving, especially given the tumult of the last several years. But according to Yahoo Finance senior columnist Rick Newman, there are some trends President Biden should be keeping an eye on. He joins us for this week's edition of Bidenomics. What should he be keeping his eye on, sir?
So I maintain the Bidenomics report card for Yahoo Finance. We measure 6 different categories of the economy every month. Manufacturing unemployment is something to pay close attention to. It has flatlined during the last few months. If you look at some indicators of the manufacturing economy, there is what economists are calling a manufacturing recession. These are the indicators we measure Biden on. You can see he's doing great on total employment. I mean, he's a beneficiary of lucky timing. Manufacturing, it looks like he's doing really good there. And what we're doing there is measuring Biden compared with the 7 prior presidents going all the way back to Jimmy Carter at the same point in their term. So Biden's leading all of them in terms of total employment growth. He just got lucky with timing. I mean, he inherited the huge COVID recovery. But watch what's happening in manufacturing, because employment has flatlined there, production is down, and that is part of what's happening as people just stop buying stuff and they want to buy services, because the COVID pandemic is over, the shutdown's over, people want to go out. But manufacturing is important to the whole economy, so that matters.
So then, Rick, what's Biden's biggest economic weakness then?
It's obviously inflation. And the question is, where is inflation going to be, let's say, a year from now, which is when the 2024 presidential election will really be happening. Now, in the Bidenomics report card, we don't measure inflation directly. We actually developed a methodology on this and with some help from Moody's Analytics at the beginning of the Trump administration, when inflation was just not an issue. Nobody was worried about inflation back then. But we do measure earnings as real earnings, which means they are adjusted for inflation. And Biden is doing poorly on that measure as well. I mean, he's second worst among all the presidents we look at. I think the only one for earnings growth, the only one who was worse was George H.W. Bush back in the late 1980s and early 1990s. So Biden's doing very poorly on that because of inflation. So I think those two things, inflation we know is coming down, but is it coming down enough to make people feel better? And I guess the last thing I would add here is messaging. People are just in a foul mood. I mean, we talk about this every time one of the consumer confidence surveys comes out. It's like, wow, people are super bummed out. We knew it was gas prices last year when they hit $5 a gallon, but gas prices are down and people are still bummed out. So we have a great job market for the most part, very low unemployment, but people are not happy. So Biden is not succeeding in getting people to think these are good times.
Yeah, can he run on this economy? And right now the answer appears to be no. It's just interesting hearing Warren Buffett talk about it earlier in the week. He said, it's just man's nature to complain. When you look at the circumstances, we're in awfully good shape. But I do want to ask you before you go about the administration, specifically the Pentagon, had its hands full with this leaker of highly classified documents. I think an arrest was made. What do we know here?
This looks like an installment of Jackass, is what we know. I mean, it looks like this was a very low-ranking Air National Guard staffer at a base in the Northeast. And I think the one thing everybody's asking right now is how did such a junior person
get their hands on this?
And it was somebody with an obvious proclivity to use classified information to show off to his friends in a small gaming forum. That seems to be what was going on here. And the fact that this guy has been apparently, I mean, we're going to learn more, obviously. So he's been watching all the news of these leaks as the information escaped beyond this little gaming forum, knowing that he's the source of all this information and he's just going to work. I mean, I don't know that he should have fled the country or something, but he seems to have been unprepared for the fact that news organizations were going to show up at his house, and the FBI knocked on his door today, apparently. So there are a lot of questions here. The biggest one is, why did this information get into this guy's hands in the first place?
And is there a gaming community behind bars? Because that's going to be his next office.
Probably so, yeah.
So,
this
an
guy's
interesting
in
view.
deep trouble, yeah.
Wow. Senior columnist Rick Newman. Good to see you, my friend.
Man.
Thank you. All right, Amazon. Let me toss it over to Rochelle.
No worries, Dave. Amazon CEO Andy Jassy committed to expanding the company's physical grocery footprint in his shareholder letter today. Jassy writing, "While we're pleased with the size and growth of our grocery business, we aspire to serve more of our customers' grocery needs than we do today. To do so, we need a broader physical store footprint, given that most of the grocery shopping still happens in physical venues." Joining us now is Poonam Goyal, Bloomberg Intelligence Senior E-commerce and Athleisure Analyst. So Poonam, I first want to read more of what Jassy wrote in that shareholder letter for you. He said, Whole Foods is on an encouraging path, but to have a larger impact on physical grocery, we must find a mass grocery format that we believe is worth expanding broadly. Amazon Fresh is the brand we've been experimenting with for a few years, and we're working hard to identify and build the right mass grocery format for Amazon scale. Now, from what he's saying, it seems like Whole Foods might not be worth expanding further. At the same time, Amazon Fresh doesn't seem to be taking off. So what is the play and the solution here then for Amazon?
It could be a combination of both, or it could be just expanding their grocery footprint. If you think about the scale that they have today with grocery, it's tiny compared to other grocers. Looking at Kroger as an example. So 500 Whole Foods stores, or a little over 500, isn't enough, right? People go out to the grocery store 3 to 4 times a week, as he said, and the grocery is a $800 billion industry. So really big, and Amazon owns a tiny, tiny piece of it. How do they expand those stores? There's really 3 ways. You grow them organically, you acquire, or you partner. Those are the 3 options they have at hand. If they grow it organically, Whole Foods or Amazon Fresh, which is a younger concept of theirs that they've invented, is the way to go. Or they need to create a new brand for grocery, which is, I think, a harder feat to accomplish because that would need now recognition and marketing. The other is to acquire. Would Amazon acquire another grocer? Would they be allowed to acquire another grocer? Those are questions that I think we would need to ask if that's the route that they choose.
Yeah, fairly certain the Biden administration isn't exactly in the move to approve transactions like that at the moment. It's interesting. I have an Amazon Fresh that was supposed to open in my tiny little neighborhood. It's been sitting untouched. They poured millions into this building, and it's been untouched for more than a year. Are they opening new locations of Amazon Fresh? And what's your best bet? What do you think they'll do in this space?
They are opening locations, but at a very, very slow pace to the extent that you just talked about. I think the problem really here is not that they can't open more stores, is I think they really need expertise to open these grocery stores. Grocery is a very different business and an in-store business, right? Amazon is an online retailer. They don't have the expertise that you need to open grocery at scale. So the question that, what I would be looking for is for them to hire that expertise. Hire someone who knows the grocery business inside out and knows how to build it with scale. You have to have locations, right? You need to know where to open the stores. You need to be able to open stores fast. That's not something that they do. They had smaller stores. They had bookstores that they closed down, and Amazon Go stores. They're very small store footprints, where to open a grocery store, you need a larger footprint. You need strip centers that are attractive. And I think they just need the expertise in that area to really scale this further if they want to.
And this is coming at a time when consumers are being a lot more careful about their spending, a lot more strategic. So then as we were sort of waiting for this US retail sales data to come out, what are your expectations there?
So retail sales are likely to slow just because the consumer is feeling a little more pressured than it was in the past. We've seen that in card data that we track through Pfizer. We're expecting a slowdown across the board. I think though still, keeping on grocery is the one area that people will still spend on. They'll trade down into lower price points when they feel a pinch, but we do think that the consumer is going to go to the grocery store. They're also traveling, right? So even though we hear all this about a slowing consumer environment, potentially a recession, the consumer is out traveling. Airline fares, restaurant sales, they're all up and they're flourishing still. So I'd say the consumer is choosing where to spend rather than completely shutting down on spending.
And connecting that to what Andy Jassy said in their shareholder letter, quote, we see a lot of trading down. People are trying to save money wherever they can. They are very deal conscious. Is that the type of sentiment that you think we'll hear throughout this quarter when it comes to retail?
Yeah, it's either going to be deals or it's going to be unique product, right? So if you're going to sell me something that I can get anywhere, then I want a deal on it. And I think we'll be hearing more of that all year. Now, if you have a product that speaks to the customer in a unique way and is truly differentiated, then the consumer will pay up for that.
And obviously, we've been talking a lot about cloud services as well when it comes to Amazon. What are your expectations there? Because obviously, Jassy setting the scene there, setting expectations for what we can expect with AWS.
Well, it's no surprise. AWS slowed in the last few quarters, and we're expecting muted results in AWS again. But all of that is really near-term choppiness, weakness, as you'd like to call it. Longer term, we agree with him. There's plenty of runway for AWS. It's about 40% of the infrastructure cloud market, and on their software side, even smaller. So really a lot of opportunity, especially as they embed AI into cloud even more. So we think long-term, 10 years from now, cloud will get even bigger. In the next 12 months, there probably is some concern for cloud to continue because businesses are pulling back on spending amid uncertainty on the macroeconomic environment.
Should be an interesting quarter. Poonam Goyal, thanks so much. Appreciate that. Coming up, the combination of higher mortgage rates and low inventory taking a toll on mortgage lenders. We'll tell you about that after the break. Good news for you home buyers. Mortgage rates continuing to cool this week. The average 30-year fix falling for a fifth straight week, albeit very slightly in this case, to 6.27%. That's according to Freddie Mac. So where are we headed, and what is the collateral damage the past year on the mortgage industry? Mike Fratantoni is the Mortgage Bankers Association Chief Economist, and Danielle Hale, Realtor.com Chief Economist. Nice to see you both. Danielle, we'll start with you. It has been a difficult start to the year, but rates are, as we mentioned, coming down. How optimistic are you that things are turning around as we enter the spring and then the peak summer season?
Yeah, I think we've seen the low in existing home sales. So I think we're going to see home sales go up from here, especially if mortgage rates remain in the lower end of the range that we've seen recently. But it's not going to be a quick climb. I think it's going to be a pretty slow climb and probably a little bit uneven too. So as consumers, buyers, and sellers get used to these lower, slightly lower mortgage rates that are still much higher than they were, almost double what they were at the start of last year. So it's a different environment, but the consumer is slowly getting used to this new normal.
Yeah, and Mike, where do you think rates level out? I think people are expecting them to get below 5. It does not appear to be the case.
Yeah, typically we think about mortgage rates as a spread over 10-year Treasury rates. Ordinarily, that would be about 2 percentage points above a 10-year Treasury, but lately they've been 3 percentage points above. A lot of that reflecting the incredible financial market volatility, uncertainty about where the Fed's headed. We've had a banking mini crisis as well, concerns there that how that's going to impact the MBS market. We do think that rates will drop below 6 as we get through the year, though, and that certainly will bring more buyers into the market.
Yeah, will it be enough to unfreeze both sides is the question. To the broader damage, MBA data shows banks and mortgage firms lost money on home loans last year. How significant was the damage, Mike?
So if we go back to 2021, your typical mortgage lender had a profit of about $2,300 per loan. Last year, they lost about $300 per loan. And this is despite the fact that lenders were doing everything they could to cut costs. Peak employment in the industry was in late 21. Lenders have cut about 18% of their staffing thus far, but industry volume fell 50% last year. So still more consolidation, still more cuts likely to come. And the purchase market remains about 30% below where we were last year at this time. So a really challenging environment for mortgage lenders.
Those are some shocking numbers. Danielle, when you're losing $300 per loan, what's the impact on buyers, on sellers, on the industry?
Well, I think the report highlights that it wasn't just buyers and sellers that have had to adjust to some really seismic changes in the financial landscape. So the industry had to shift to, and everyone has had to be pretty nimble. And, as the market was going through this transition, it made it really difficult to know what to expect. How high were mortgage rates going to go? What did that mean for affordability for buyers and sellers? Does that mean, do I hurry up and try to buy now? Do I wait it out and try to buy on the flip side as mortgage rates eventually come down, which many expect? What's interesting is that even though we've seen mortgage rates start to ease, as inflation seems to be getting under control, the labor market is still largely chugging along, consumers are still expecting mortgage rates to be a bit higher. So that may mean as we see these dips in mortgage rates, some buyers are going to try to take advantage of these opportunities to get into the market. And in fact, we saw that with the February existing home sales data, that home sales surged in response to lower mortgage rates to start the year. And so we may see this up and down as mortgage rates fluctuate up and down in the sales environment in the year ahead.
Of course, inventory remains a massive issue. Some more stunning numbers from MBA there, Mike. Just 32% of mortgage firms were profitable last year, down from 98% 2 years prior. What does this mean moving forward for loan conditions for buyers and for sellers?
Yeah, so 2021 was a record refinance year, and given that so many homeowners refinance to rates of 3% or below, there's just not that refinance opportunity right now. So that's the major scaling factor for the industry. But as I mentioned, with rates more than doubling last year, as Danielle said, purchase volume is way off too. And some of that is affordability, but I totally agree with where Danielle was going, where we're seeing in our purchase application data, any week you get a drop in rates, home buyers are back in putting in applications for a mortgage. And really the constraint is on the supply side, the only 2.5 months of inventory on the market in terms of existing homes. So it's been a very challenging environment for lenders. I think from the consumer's perspective, that means you've got a lot of lenders out there who are more than ready to help you and help you get that right loan for that home purchase.
That's interesting. When you take this all into perspective with the SVB collapse, how much more difficult, or maybe to Mike's point there, Danielle, is it going to be easier to get a loan in the next several months as we get into the hot summer season?
Yeah, I think this year you're not going to have the same refinance demand as Mike was talking about. Lenders are eager; they're looking for business. So as a consumer, it probably makes sense to shop around. That's always a good idea, but especially now in these market conditions where you might find lenders that are more or less willing to work in your situation. As Mike noted, inventory is still a problem, even though we see that the number of homes on the market is up about 44% compared to a year ago. They're still down about half from where they were before the pandemic. So it's a bit of a glass half full, glass half empty. Depending on your comparison point, things are a bit better, but there's still more room to see improvement in the market to get things back to where we were before. The other thing that I would note that's sort of a good news, bad news story for buyers, homes are sitting on the market a little bit longer. That gives them more time to make decisions, which is especially important for first-time home buyers who want to take the time to make the right decision. On the flip side, we're not seeing as many homeowners decide to sell, and so there's not as much churn or refresh in the housing market. A lot of the additional homes that are on the market today have been sitting for a while. So if you're looking for something very particular as a consumer, you might have to wait a little while to find it or loosen up your criteria in order to get into a home that works for you.
Mike, is now the time then for prospective buyers to feel empowered and to shop around and have a little control over the type of loan they can get right now?
Well, I think in terms of the home selection out there, that's really the challenge, right? Just not enough properties to look at. And I think some folks might get the impression with this overall picture that, home prices are dropping, but honestly, we're not seeing it in the national data at this point. Certainly West Coast, mountain states are seeing some declines. So I think, wouldn't want to give a buyer a false impression that this is a weak market where they're going to have a huge amount of leverage. But compared to where they were last year or the year prior, I think that buyer does have more leverage in the home buying process. And then, as I mentioned, in the lending process, absolutely. You got thousands of lenders out there who are very eager to work with you, given the challenges they're facing in terms of drumming up new business.
All things relative in real estate. Mike Frattantoni, Danielle Hell, thank you both. Appreciate that. Rochelle?
Thank you.
All right, a stock to watch for tomorrow, Wells Fargo. The company among the major banks reporting ahead of the open tomorrow. The bank expected to report adjusted earnings of 67 cents per share on revenue of $19.66 billion. Of course, it's been a volatile month for banks in the aftermath of the failures of Silicon Valley Bank and, of course, Signature Bank. And we'll get a first look at what it means for the broader industry. One key item to watch, the balance sheet, especially when it comes to commercial real estate and the exposure there. Lessons learned after decades in finance. Brian Sozzi sat down this week with Carlyle Group co-founder David Rubenstein for a wide-ranging interview. Here's what he had to say about missed opportunities and what he's learned.
Did you invest in Jeff Bezos and Amazon when he was coming up?
We had a stake in the company, but we sold it prematurely. Let's put it that way.
Are there any other ones that you have interviewed you're like, I regret not investing in that company? Or leader.
Well, I had a chance to invest in Mark Zuckerberg's company when he was in Harvard, and he was looking for a little bit of money. My son-in-law told me about it, and I passed on that. When Mark Andreessen was trying to raise money for Netscape, we told him that would never get anywhere. We turned that down, so I've had a lot of regrets.
What did you learn from those?
Don't assume that because somebody doesn't look like you that he doesn't know what he's doing. So if they come in, they're wearing sandals, long hair, they're not dressed well, that might not mean that they're not a good investor.
Really looking forward to that one. So tune in tomorrow for more of Brian's interview with David Rubenstein on Yahoo Finance. His take on state of the private equity market, the stock market, Fed policy, and of course, much more. All right, stay with us. Coming up, for the first time in nearly 2 years, some new cars are starting to sell for below their sticker prices. We'll have more details after the break. New vehicle prices fell below sticker price in March for the first time in nearly 2 years. That's according to Kelley Blue Book. Last month, consumers paid on average $171 below sticker price for their cars. Compare that to March of 2022, when consumers paid on average $1,000 over sticker price. Well, let's dive into the data with Brian Moody, Kelley Blue Book Executive Director. Brian, thank you for joining us today. So, clearly a very different picture from where we were a year ago. Talk about what broke this 20-month streak.
Well, it mostly has to do with supply. So the inventory is up, and when that's the case, you have prices come down a little bit. But it's also helped by the fact that with that inventory, there's also a little bit of incentives by the automakers. So when they offer a little bit of a discount, that helps the average transaction price come down as well.
So it was an interesting dynamic during the pandemic because those dealers had low inventory, but that drove the sticker price way up. Right. Do you expect this to be the new model now that inventories, are they going to stay high?
I think a lot of dealers have realized they don't need to stock as much inventory as they once did. So I don't know if inventory is going to stay high, but one thing we don't have now that we used to have was simply a ceasing of producing cars. If you remember, right, some manufacturers cut production because they were afraid they wouldn't have cars to sell, or they cut production so they could make medical equipment. We're not going to have that. So that's one thing that's a factor we can kind of remove. So we have high supply. Will we have the demand going forward? Because when demand is there, then prices can still remain high, even when there is lots of supply.
And Brian, in your notes, looking at the luxury buyers contributing to prices staying elevated for longer, at some point, Are they going to pull back so that we could see prices don't come down more?
I don't know. That's a great point. And so that's been the case for quite some time. Is what we've seen is the luxury buyers at one point, it's nearly 20% of the market. That's very high compared to, say, 2018, when it would have been more like 13 or 14%. Those luxury buyers, meaning that percentage, 18 to 19% of new car buyers are opting for luxury brands. That pushes the average transaction price of everything up. So yes, it does have an impact. One thing we're noting is that luxury vehicles are still transacting over MSRP. It's largely the non-luxury vehicles that are transacting under MSRP, even if just barely, and there are maybe just a couple of exceptions to that.
When it comes to EVs, Elon Musk has dominated the headlines there with several price cuts. What'd you see industry-wide and why?
Well, at first we saw electric car prices come down somewhat, but now we're seeing them go back up. And that despite what you just pointed out, which was that Tesla cut prices quite a bit. And Tesla is the #1 seller of electric cars in the US. In fact, they're the #1 luxury seller of cars in the US. But the price of electric cars is trending slightly upward. And here's why we think that is, because there are just more choices coming online, more models from Mercedes-Benz, more models from brands like Lucid and Rivian, and those are somewhat pricey vehicles.
And you know, the auto incentives offered by manufacturers still at historic lows here. What do you think is going to incentivize them? Or are they currently in a position where they just don't have to offer incentives?
Well, so here's a good way to think about it. When inventory goes up, the incentives can go up. When the inventory goes down, the incentives can go down. They don't need to offer the discount. But as you pointed out, they are at historic lows, but they're trending upward. So right now, as part of a transaction price, you might find a roughly $1,500 discount on average as part of a manufacturer-provided incentive program. So historically low, but trending up.
So your data showed prices coming down, but not necessarily for Honda nor Kia. Why?
Right. I think the answer to that is kind of simple. They make great cars that really resonate with people. They have lots of new models, they have very compelling designs. They have a reputation for being good vehicles. And I think that those prices are trading on the strength of their brand, because honestly, some of those cars, they aren't that much different than what you might get from some other manufacturer, but the names of those vehicles, the brand Honda and Kia, it means something to someone. And so therefore, the people who are out there shopping for that are saying, I'm okay paying a little bit more because I know that this is a good quality car.
So for people who are in the market for a new car, they're seeing some of these prices come down, but also keeping one eye on some of these loan interest rates continuing to tick up. What is the best strategy right now if you're in the market for a car?
If you're in the market for a car, look at new and used both equally. It could be that the model you're looking for, there's a better deal to be had new or a better deal to be had used. Look at both equally. Also, put as much money as you can down, because the interest rates are not necessarily in your favor, and we're still seeing credit becoming relatively difficult to get, although not impossible. Of course, they want to sell you a car, they want to sell you a loan product, so they're going to find a way. I would just come up with as much money as you can put down, finance for the shortest period of time possible, and stay within your budget. Don't get tempted by monthly payments. Anybody can sell you a Lamborghini for $500 a month. How many months? That's the question. Keep that in mind.
I don't have to worry much about the Lamborghini payments, but I get the sentiment indeed. Brian Moody, Kelly Blue.
You and me both. You and me both.
You got that. Thank you, sir. Appreciate it. All right, it's closing time here at Yahoo Finance. Let's get you caught up on some of the biggest headlines of the day. We got another sign inflation is cooling. Producer prices fell in March, with the producer price index falling 0.5% from a month earlier. Stripping out the more volatile food and energy components, prices fell 0.1%. That sent stocks higher, with the Dow closing higher by 383 points. And check out the Nasdaq up 2%.
And of course, Amazon CEO Andy Jassy updating shareholders in his annual letter. Jassy addressed everything from the company's cost-cutting measures to the tech giant's AI plans. He also discussed issued a warning about its AWS business, saying the unit, quote, faces short-term headwinds as companies start to pull back on spending.
And finally, earnings season kicks off tomorrow with JP Morgan, Citigroup, and Wells Fargo all reporting their first quarter results. Given the chaos with regional banks the last several weeks, we'll be listening closely to what earnings call say about CEOs in the banking sector. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern Time, for all your coverage leading up to and after the closing bell. For Michelle Akufo, I'm Dave Briggs. We'll see you tomorrow.